Since 2007 and 2008, a few thousand people in Bulgaria are victims of a very ruthless predatory lending by three banks: EFG Eurobank Bulgaria, UniCredit Bank and Piraeus Bank. Many families are already ruined and millions of Swiss francs stolen away from them. And not only that, but their homes and everything they own have been taken. Only a few are still managing to keep on paying a mortgage at a massively increased interest rate, up to 9.6% for a loan which is denominated in Swiss francs, with a contract which is full of unfair clauses. Our association was founded in 2015 with a main purpose to help all these victims through their difficult times by giving them support and legal advice and making the problem known to the public and all the relative bodies in Bulgaria and the EU to achieve a legal justification. Because of our active work, the Bulgarian Commission for Consumer Protection lodged in court 3 collective lawsuits against the above-mentioned banks, but currently undergoing there are only 2 against UniCredit and Piraeus Bank. The lawsuit against EFG Eurobank was ceased before our association and all concerned parties started to participate actively in it. The Bulgarian Commission for Consumer Protection and EFG Eurobank, in our absence and without our knowledge, on the 18th of November 2016, signed an out-of-court agreement, and the Bulgarian Commission for Consumer Protection withdrew its claim. The signed agreement is a knife in the back of the Bulgarian consumers, and we publicly express our considerable disappointment and disapproval. Sadly, the reality in Bulgaria is not what it appears to be. The big financial institutions are like octopuses spreading their tentacles to the media, politicians and government organisations. Here's some background on the denominated Swiss franc loans dispersed by Eurobank in Bulgaria. It all started with a false and misleading advertising on the type of loan the consumers would be signing up for. Consumers were promised a low interest rate because Libor is lower than Euribor and Swiss franc is a very stable currency. For such misleading advertising, Eurobank has already once been convicted in court of a wrongdoing and in breach with a good commercial practice, and they were ordered to pay a penalty. Eurobank displayed a very oppressive behaviour when promoting the Swiss franc denominated loans. Its employees were aggressively working towards convincing every borrower to convert his Lever or Eurobank loan into Swiss franc. The fact is that none of our victims asked for a loan in Swiss francs. Many of them are not even familiar with that currency. The fact is they never withdrew Swiss francs from their accounts. Through an accounting operation, the bank converted the initially requested euro to Lever amount or into Swiss francs basically, and took a commission for it, and it obliged the borrower to repay the Swiss francs and then converted all the remaining, less commission and bank taxes, Swiss francs back to euro or Lever, and then made the funds available for the borrowers. But the story did not end there. The saga with the unfair and abusive behaviour of Eurobank continues from 2007 until present day. In 2008, Eurobank several times increased the interest rate of those types of loans, first with 0.5 percent points and then a significant 2.2% points. In October 2008, the Swiss National Bank came with 3 extraordinary decisions regarding the cost of borrowing Swiss franc and respectively its effect on the exchange rate. The Swiss bank clearly demonstrated its commitment to an easing of the money market and gradually was working towards reducing the Libor to 0 and then negative territory. But this did not reflect the costs for the borrowers in Eurobank. In January 2015, when the Swiss National Bank decided to discontinue the minimum exchange rate of 1.2 Swiss franc per euro, and in the meantime to lower the Libor from 0.25 to 1.25 minus, to ensure the discontinuation of the minimum exchange rate does not lead to inappropriate tightening of monetary conditions. After all, instead of reducing the interest rate, Eurobank started to put pressure on a few surviving borrowers to convert their loans into Lever at a historical high Swiss franc Lever exchange rate. and to sign against artificially inflated and significantly higher than the initial principal. This extortion continues up until present day. The signed contracts with all borrowers are standard, they're not negotiable, they are one-sided and full of unfair contractual terms. In breach of Council Directive 93/13/EU on the 5th of April 1993 on unfair terms, consumer contracts and Bulgarian contractual legislation. These are the findings regarding the unfair clauses. The obligation of the borrowers to repay their loans in the currency they never requested and never withdrew from their accounts. The way the interest rate is formed is unclear, there's no formula, there's no methodology described in the contract, and this enables the bank to just change it at will. The currency exchange rate is fully transferred to the borrower and there's no provision to safeguard the customer from this exposure. When the contracts were signed, the borrowers were not provided with this crucial information. Also, Eurobank transferred all denominated in Swiss franc loans to a company called Bulgarian Retail Services, and the borrowers are again in a precarious situation because the conditions under which the transfer was made were not made clear to them. They are in no way informed on what basis and under what conditions this has been done. The borrowers are not advised of their rights and obligations to the new firm and under what conditions the relationship between the parties would continue. Currently, there are hundreds of personal lawsuits against EFG Eurobank Bulgaria AD, UniCredit Bank AG and Piraeus Bank in Bulgaria. The court ruled that the clauses of these contracts are to the detriment of the consumer because they give uncontrollable rights to the other party, they do not meet the requirements of good faith because the bank did not take care as the good coordinator of the contract basically when signing the agreements, and they led to an imbalance of the rights of both parties, giving exclusive rights only to the bank to change uncontrollably the content of the contractual relations between the parties. There is a proceeding pending before the Court of Justice, EU case C119/17, and the preliminary rulings are of a crucial importance for the outcome of the cases in Bulgaria, because under the terms of the concluded contracts for credit, the amount of the agreed credit between a specific amount is defined in Article 1 solely euro and leva and not in Swiss francs, notwithstanding that in Article 2, paragraph 1, it's provided that the credit is taken in Swiss francs and borrowers have no access to their Swiss franc accounts because they're blocked accounts. The Swiss francs from the blocked accounts are ex officio converted from the bank, euro leva, before they're to be utilised, and the actual withdrawing by the consumers from their accounts is made in euro leva. As can be seen from the above, cash flow from the lender to the borrower in Swiss franc does not exist. The actual allocation and utilisation of the loan is in euro or Bulgarian leva. But despite all these challenges, we do not give up the fight, and we're confident that soon, rather than later, justice will be served. These unfair bank practices will be removed and these toxic loans converted back to the currencies in which they've been requested initially, at the exchange rate on the day and the time the loan was dispersed. We agree with the Greek media. The lawsuit against Eurobank will be an example, and this is crucial.